Welcome, curious minds. Today, we're going to dig into a company whose services, well, they quietly power over 1 million businesses. We're talking Cintas Corporation.
That's right.
We've got their latest fiscal 2025 numbers, that's Q4, and the full year, plus their first look at fiscal 2026.
Yeah, and this isn't just, reading off a spreadsheet. We're trying to understand the engine behind this company. They show such consistent growth. It's kind of remarkable.
Exactly. We've gone through their official press release, the exec conference call, to really pull out the key takeaways for you. We want to get past the headlines and figure out Cintas' strategy, how they handle, the ups and downs of the economy.
And what makes them keep delivering value year after year.
So our mission for you today, let's unpack these reports, find maybe some surprising bits, and help you really grasp the strategies that make Cintas work.
Yeah.
So as we start peeling back the layers here, what's the first thing that jumps out at you?
It's got to be the consistency, just sheer long-term consistency. We're talking decades. Not many companies have that kind of track record, and you really see that reflected again in these latest numbers. It points to something fundamentally stable about their business, maybe less tied to the usual economic cycles than you'd think.
Okay, so let's get right into it then. The headline figures for fiscal 2025, the year ended May 31st. Big picture for the full year, record revenue.
Yeah.
Over $10.3 billion. That's up 7.7% from the year before. Solid growth.
It is solid. And, that top line number is impressive, but what I always look for is that organic revenue growth.
The core health metric.
Exactly.
Yeah.
For the full year, that came in at a really robust 8.0%. And that number's key, like you said, because it cuts out the noise acquisitions, currency swings, even differences in workdays.
So it tells you the underlying business is just growing from actual demand and, good sales execution.
Precisely, not just financial engineering or buying growth. And when you tie that back to the consistency thing,
Yeah.
Cintas has managed sales and adjusted EPS growth in, get this, 54 out of the last 56 years.
Wow. 54 out of 56. What does that kind of track record even tell you about their business model, especially when the economy feels so, unpredictable?
Well, it's more than just impressive, right? It strongly suggests they're operating with a demand curve that's just fundamentally stable.
Oh, so?
Think about what they do. Uniform rentals, facility services, safety gear. For a lot of businesses, that stuff isn't really optional. It's non-discretionary.
Right, you need clean facilities, safe workers, sometimes mandated uniforms.
Exactly. So it gives them this powerful competitive moat. It's almost like, a picks and shovels kind of play for the modern economy. Makes them surprisingly resilient.
That makes a lot of sense. And they're not just getting bigger, they're getting more efficient doing it. Profitability is up.
Way up.
For the full year, Cintas hit an all-time high gross margin, 50.0% of revenue. That's up 120 basis points.
And just to clarify for everyone, 120 basis points, that's 1.2 percentage points. That's a pretty significant jump in profitability at this scale. And operating income, also an all-time high for the year, 22.8% of revenue, up 14.1% year over year. That shows they're really good at converting that top-line growth into actual operating profit. Speaks volumes about their operational discipline.
And net income, EPS, they followed suit. Strong growth there, too, even after accounting for that 4-for-1 stock split they did back in September 24.
Right. Adjusted for the split, of course.
So, okay, the numbers paint a really healthy picture. But the question everyone's probably thinking is, how? How are they actually doing this day to day? What did we learn about maybe their operational secrets?
Well, it's pretty clear they get that growth isn't just about landing new customers. It's also about going deeper with the ones you already have.
The land and expand idea.
Kind of. Their COO talked about it. They grow by helping new customers, yes, but also by adding new products and services for their existing clients. And get this. Retention rates are at all-time highs.
Wow.
And pricing is at historical levels. That tells you customers are sticking around because they see the value.
That's a really powerful indicator, high retention. So where's the growth strongest? If we look at the Q4 organic growth by segment, their main uniform rental and facility services, that grew a solid 7.2%.
Steady Eddie.
But the big surprise, for me anyway, was first aid and safety services, an explosive 18.5% jump.
Yeah, that really stood out.
What's behind that kind of growth? And tell us about how Cintas maybe spots and jumps on specific market needs.
That's a great question. First aid and safety, yeah, phenomenal quarter. It definitely shows they can respond, maybe even anticipate where the demand is going. Their fire protection services were also strong, up 12.1%,
And uniform direct sale.
up 9%. It shows, they're more than just uniforms these days. It's a pretty diverse service mix.
It's almost hard to picture the sheer scale behind those numbers. You think Cintas, maybe you just think uniforms.
Right.
But then you hear about auto sortation systems, smart trucks. It sounds more like a high-tech logistics company.
It really does. And those things you mentioned, they're key to the margin improvements.
Okay, so what specific initiatives are driving those gross margins up?
Well, they credit their supply chain team, obviously, but also some really smart cost-saving moves like garment sharing. They use their SAP system to share uniform inventory across their whole network. Very efficient.
Makes sense.
They're rolling out advanced auto sortation systems in their plants. About half the plants have some level of that tech now.
Okay.
And that smart truck solution, it optimizes delivery routes. Less time driving, more time with customers. It's clear this isn't just, a one-time fix. It's a culture of constantly finding those little efficiencies.
In that first aid and safety segment, the margin increase there was huge, too.
Yeah.
140 basis points on the gross margin side. How'd they manage that?
It was a few things working together. Strong revenue growth gives you operating leverage, right?
Sure.
Plus, they had a good mix of high-margin recurring revenue stuff. Think AED rentals, eye wash station services, water coolers.
The subscription-like services.
Exactly. And then layered on top, cost savings from things like Smart Truck again and better sourcing. It's really a kind of a holistic approach to getting more profitable.
So how does Cintas actually go about winning new business or expanding with the customers they have? The COO told a story, right, about becoming problem solvers for a client.
Yeah, it's a great example, actually. It really illustrates how they operate. So they'd been providing just facility services, cleaning supplies, mats, that kind of thing for this one customer for like over 10 years.
Okay, long relationship.
Right. Then the customer comes to them with problems related to their maintenance department uniforms.
Mm-hmm.
3 main pain points. Forecasting the spend was tough. The employees actually wanted laundered uniforms, not just buying their own. And the managers were spending way too much time dealing with uniform logistics.
Sounds like a classic operational headache.
Totally. So Cintas steps in, pitches their uniform rental program, and boom, solves all 3 problems. They didn't just sell a service, they became a partner, a problem solver.
That's a fantastic way to build trust. But the story didn't end there, did it?
No, it didn't. Because they'd earned that trust, they then got a chance to talk to the culinary department.
Another part of the business.
Right, and they ended up converting them away from a traditional competitor, The Hook. Cintas offered premium ChefWorks gear exclusively, plus the customer could consolidate vendors. Make life simpler.
That's really insightful. So what are the big takeaways from a story like that? What does it tell us about their growth strategy?
Well, it shows a few key things. 1, they don't always have to lead with uniforms. They can start elsewhere. 2, they can convert businesses that were doing it themselves, the no programmers, as they call them.
Right, the DIY approach.
3, they can absolutely win business from competitors, especially if they offer something premium or solve a bigger problem like consolidation. And maybe most importantly, 4, they grow by adding more services to existing happy customers.
That focus on problem solving and listening to the customer, that sounds like a huge part of their competitive advantage, their moat.
Absolutely. It seems critical.
Okay, so we've seen the impressive numbers, the operational smarts, but how is Cintas actually managing its cash? Investing for the future. They obviously have a strong balance sheet, generated, $1.76 billion in free cash flow in fiscal 25.
Yeah, a healthy chunk of change. And their approach to using that capital seems pretty balanced. It shows they're confident in their own internal growth, but they're also looking outside for opportunities.
So how do they prioritize?
Well, first, CapEx. They invested about $409 million in fiscal 25. That's around 4% of revenue, mostly into technology and keeping their infrastructure up to date. They plan to keep that spending in the 3.5% to 4% of revenue range.
Okay, standard reinvestment. What about M&A? Acquisitions. Heard they were pretty active there.
They really were. Spent about $233 million on acquisitions in fiscal 25. Apparently, that's their biggest M&A year in almost 20 years, if you exclude one really huge deal they did way back in 2017.
Interesting. What kind of companies are they buying?
It sounds like they spanned all 3 of their main route-based segments: uniforms, first aid, fire, Adding customers, yeah, but also extending their geographic reach or capacity and finding synergies by, making their routes even more efficient. So it's strategic buying, not just buying for size.
And returning cash to shareholders, that's obviously a big piece too.
Oh, absolutely. Dividends first. Paid out over $611 million in fiscal 25. That's up more than 15% from the year before.
And the streak continues.
The streak continues. Get this, 41st consecutive year of increasing their dividends since they went public.
41 years. That's incredible. It signals real long-term commitment and, frankly, confidence.
It really does. And on top of dividends, they bought back about $935 million worth of their own stock in fiscal 25.
So dividends plus buybacks, they returned over $1 billion to shareholders.
Yep, over $1 billion. That balanced approach, investing internally, acquiring strategically, and returning cash, it really speaks volumes about their financial strength and their outlook.
So speaking of outlook, let's look ahead. They gave guidance for fiscal 2026. What's the forecast?
Okay, so for fiscal 26, they're projecting revenue between $11 billion and $11.15 billion.
Which translates to growth of?
About 6.4% to 7.8% total growth. And for diluted EPS, earnings per share, they expect between $4.71 and $4.85. That's growth of 7% to 10.2%.
That's still a pretty strong outlook, especially given, all the economic uncertainty out there. You'd think maybe there'd be some cracks showing. Did the execs talk about any headwinds or challenges they're facing?
Yeah, that's a fair question, and they did address it. Interestingly, they said they're seeing no significant change in customer behavior or how long it takes to close a sale.
Really? Despite inflation, interest rates, all that?
Seems so. New business is still strong. Retention rates are, as we said, very attractive. They acknowledge there's more uncertainty in the marketplace, things like tariffs, trade issues, rates.
Yeah.
But they basically said their value proposition just keeps resonating regardless of the economic cycle. That seems to be the core of their resilience.
And it looks like they expect to keep improving margins, too, in fiscal 26.
Yeah, the guidance implies that. Operating margins look set to stay above 23%. And they talked about incrementals in the high 20s. Meaning for every new dollar of revenue they earn in, a pretty high percentage, close to 30 cents, is expected to drop straight to the operating profit line. That's efficient growth.
That is efficient.
Yeah.
And how are they planning to manage costs, especially with things like potential tariffs looming?
Right. Tariffs are definitely on people's minds. Cintas feels they're pretty well set up to handle it. They mention a few things. One, the way they amortize goods gives them some lead time to adjust. Two, they've actually increased inventory levels to buffer against impacts.
Proactive.
Three, their global supply chain is diverse. They source from all over. Apparently, over 90% of their products have at least two potential suppliers. Gives them options, leverage.
So they're not overly reliant on one region or supplier. What else helps?
I think it comes back to that culture of efficiency we talked about. They used phrases like positive discontent and competitive urgency.
Meaning they're never satisfied.
Pretty much. It drives them to constantly hunt for ways to be more efficient internally, rather than just automatically passing cost increases onto customers. And those specific things, garment sharing, auto sortation, smart truck, they expect those to keep delivering savings.
Okay, what about their overall strategy? How they go to market, focus on certain industries. Any big changes planned there?
Doesn't sound like it. No major shifts. Their vertical strategy, where they organize sales and service around specific sectors like healthcare, government, education, hospitality, that seems to be working really well for them.
How so?
By focusing like that, they gain, quote, intimate knowledge of those industries. That lets them innovate specific solutions. Like they mentioned a scrub dispensing service for healthcare or patented privacy curtains. And often those innovations end up having applications beyond the original vertical.
Clever. Fosters organic growth from within. And back to that first aid and then safety growth spurt in Q4. Is that pace sustainable?
Good question. They acknowledge that Q4 got a boost from a, quote, spike in training demand, which they don't expect to repeat at quite that same level.
Okay. Bit of a one-off element there.
Right. But the underlying business is still performing really well, driven by demand for those recurring revenue products, AEDs, eye wash stations, etc. They're guiding for that segment to grow in the low double digits in fiscal 26. Still very strong.
Still very impressive. And quickly, any mention of AI or advanced tech beyond what we've discussed?
Yeah, they touched on it. So they've been investing in tech for years. SAP, data analytics, algorithms, AI and machine learning they see as being in the early innings for them. But they definitely see opportunities there, making things easier for their employees, easier for customers. They expect it to lead to incremental improvements over many years. Not a sudden revolution, but steady progress.
Wow, okay. What a deep dive that was.
Yeah.
We've really gone through Cintas's financials, from those record revenues and impressive margins to how they invest strategically and that incredible commitment to shareholder returns.
Yeah.
It's pretty clear their strategy, winning new customers, yes, but also converting do-it-yourselfers, taking share from competitors and expanding with existing clients. It's really firing on all cylinders.
It really is. And that dedication to operational excellence, the garment sharing, the smart trucks, combined with how they proactively manage costs like tariffs, it just paints a picture of a very disciplined, very adaptable business.
They're not just sitting back and reacting, are they?
No, it seems like they're constantly tuning the engine, constantly investing for the long haul, which is frankly kind of rare to see executed so consistently.
So here's the final thought, the thing to maybe mull over. When a company keeps emphasizing that its growth comes mainly from increasing volume, more customers, more services, and providing more value, rather than just relying heavily on price hikes, what does that tell you? What does it say about their competitive strength, their moat, and maybe their long-term potential, especially in an economy that always seems to be shifting? Something to chew on until next time.